Broadly speaking, commodities are goods that practically have the same use and quality regardless of their source. For instance, no one cares where a gold bar came from, but everyone recognizes its value. On the other hand, the market differentiates between diverse brands of electric cars, although they all use nickel and lithium in their batteries, and no one cares where those come from. So commodities are the raw materials and goods that more complex products are made from. Commodities are classified as either soft or hard. Soft commodities are grown and include agricultural produce and livestock. Meanwhile, hard commodities are mined and include metals, minerals, and energy. Agricultural produce are grouped into softs and cereals. Softs include cotton, coffee, orange juice, rubber, sugar, lumber, and wool. Meanwhile, cereals include wheat, corn, soybean, rice, oats, rye, barley, millet, and rapeseed. Livestock includes cattle, beef cattle, hogs, and pork bellies. Metals are grouped into base or industrial metals and precious metals. Base metals include aluminum, copper, lead, mercury, nickel, tin, zinc, and titanium. Meanwhile, precious metals include gold, silver, platinum, iridium, palladium, osmium, and ruthenium. Minerals include the rare earth minerals of the 15 lanthanides on the periodic table, plus scandium and yttrium. Lastly, energy includes crude oil, petroleum, gas oil, natural gas, heating oil, coal, unleaded gasoline, and electricity. Directly owning commodities involves buying and storing the physical commodity, but the logistics of an individual doing this is challenging. Just imagine transporting and storing a barrel of oil. A more practical and indirect way to own commodities is by buying commodity-related equities, futures contracts, commodity CFDs or contracts for difference, commodity ETFs or exchange-traded funds, and commodity mutual funds. Commodity-related equities are shares of companies in the materials equity sector. A downside of this approach is that the share price of these firms may not correlate with real-time or spot commodity prices due to the business's financial structure, the health of unrelated businesses, and any futures contracts the companies may have. Futures contracts are agreements to buy a certain amount of a commodity in the future at a price set in the past. If the commodity's price rises in the future, the existing futures contract to buy it at a lower price becomes more valuable, and the reverse is true. These contracts are usually out of reach for individual investors due to the significant cash commitment needed and what that means for their portfolio allocations. For example, a gold contract could involve buying 100 troy ounces of gold, which amounts to a $200,000 commitment. CFDs are derivative products or financial contracts that pay the differences in price between the open and closing trades. When you enter a CFD, you are speculating on the future price movements of the underlying commodity without actually owning it. Most commodity CFDs use leverage, which can be a boon or a bust for smaller investors as it increases their exposure to the volatile commodity markets using borrowed money. Commodity ETFs are ETFs that hold physical commodities, commodity-related equities, futures contracts, or CFDs, with investors buying fund shares representing units of the ETF's total holding. Lastly, commodity mutual funds are mutual fund equivalents of commodity ETFs. This graphic from Technopedia shows the major factors that affect commodity prices. Physical or real assets like commodities are governed by supply and demand and increase in value with rising inflation. When demand for finished products exceeds supply, the cost of those products rise as the demand and price for the commodities needed to produce them spike. So in addition to diversifying investment portfolios, commodities also offer inflation protection. But their heavy supply and demand dependency means they lose value during economic slowdowns and periods of disinflation or deflation, demand decline, and supply limitations. Such periods are often caused by unfavorable market, political, and regulatory conditions, as well as natural disasters and deflationary new technologies. Since these factors are very unpredictable, commodities are a highly volatile asset class. In fact, they are just about as volatile as equities. The high volatility in commodities can be moderated by holding a diverse basket of them. That's because there isn't a high correlation between different commodities. so total returns for a basket of them should be less volatile than it would be for any one commodity. Ideally, the baskets should be benchmarked against a diversified index like the Bloomberg Commodity Index. These performance charts of 5 commodity ETFs include dividends and demonstrate the benefits of holding a diversified commodity basket since 2015. Rather than being down 11% if you only own the agriculture ETF, you would be up 21% if you own the basket ETF instead. However, he wouldn't have performed as well as the gold ETF's 40% total returns. Moreover, the impact of currency exchange rates can be dramatic since most commodities are traded in US dollars. For example, in Canadian dollar terms, none of these US dollar-based ETFs have negative total returns as the US dollar became much stronger. Right, that does it for the commodity asset class. Next, we'll delve into the alternative asset class.